Today, I share our Tfsa dividend income for the month of September. Let's do this! Before I jump into who paid us and how much, let's take a brief look at our portfolio's dividend calendar. You probably noticed, as always, January, April, July, and October are the heavy months, and February, May, August, and November are the light months. March, June, September, and December land somewhere in the middle. I'll share our dividend income based on when it lands in our account, not based on the payout date, as these can sometimes differ from brokerage to brokerage. In September, we received dividends from the following 11 companies. I'll go through each holding according to the dividend weight, not payout size, in my portfolio, starting with the smallest. I'll be adding up the totals along the way. Let's see where this month lands compared to the previous quarter. Our smallest dividend received was $13.25 from Canadian National Railway. CNR provides 1.6% of our total dividend income. This should be much larger, however, I haven't really purchased any shares in the past few years. I'm looking for it to land in value territory again, and then I'll reinvest some of the dividends back into it. CNR is trading above its 5-year average dividend yield of 1.7%. Just recently, they had a huge 19.1% dividend raise. They continue to look like the better of the two Canadian railways. Next, Canoe EIT Income Fund paid us $23. It provides us with 3% of our yearly dividend income. This closed-end investment fund is the only income stock we own. It isn't part of our strategy, but we've held it forever and I can't seem to cut it loose. Still. After our first 2 paychecks, we were at $36.25. Next up, you are paid with a big thank you. We passed 500 subs the other week, and it's only because of the awesome viewers that leave these meaningful comments that have made starting YouTube totally worth it. I can never say thank you enough for all the support my wife and I have received putting ourselves out there. Our smallest utility, Fortis, paid us $72.77 in September. This gives it a weighting of 3.1% of our yearly dividend income. Fortis has been a stable and steady grower over the years, with price growth and dividend growth both around the 6% mark. Right now, it is yielding 4.3%, which is rich compared to its 5-year average yield. At this price, I have my drip turned on and enjoy the cheap accumulation of shares. I hope the share price drops a bit more so the stock can come in line with my rule of 12. And we already break the $100 mark at $109.02. Next, we were paid $96.69 in dividends from Manulife Financial Corporation. They provide us with about 3.9% of our annual dividend income. This has been a core holding in our portfolio. They continue to grow their dividends at a rate of 9.6% over the past 5 years, with a massive 17.9% raise at the end of last year. The share price has been stagnant for years now, but this still doesn't bother me in the accumulation phase of investing. I look to continue to add to this position as the PE is well below the historical average of 10. That brings us to $205.71 for the month. The next paycheck from Great-West Lifeco Inc. was $111.27. GWO provides us with 4.5% of our yearly dividend income. It is trading well above their average 5-year yield of 5%, which could indicate it is undervalued right now. But the market is a mess. They would be normally raising dividends around this time of year, but I have a strong feeling, they'll try to conserve some cash as their payout ratio has now risen to 58%. This is quite a bit higher than the industry average of 40%. So after 5 paychecks, we are at $316.98. Our next dividend received was $38.22 from Pembina Pipeline Corp. It pays us 4.9% of our yearly dividend income as one of 3 in the energy sector. We are in a pretty good position with 15% of our income coming from the energy sector. I don't want to go above 20% as I find the energy sector quite volatile, cyclical, and overweight on the TSX. You'll notice we have no income from energy producers. It is for the same reasons. So, just past the midway point, we are at $355.20. By the way, I'm curious to know your thoughts on our dividend weighting in our portfolio. Please share your thoughts in the comments. I'm happy to engage in some healthy conversations about dividend income weighting. Next, we were paid $44.66 in distributions from Smart Centers Real Estate Investment Trust. They provide us with 5.8% of our forward annual dividend income as one of 2 companies in the real estate industry. This remains a staple in our turf portfolio with its monthly distributions and predictable revenue from its tenants. The market took more of a hit this month and has dropped below my yield on cost. This could mean it is around fairly valued right now. I'll continue using their monthly distributions to reinvest in Smart Centers. Smart Centers own many amazing properties in prime locations. They have plans to densify them in the future and include some residential to their income mix. With our 7th paycheck, we almost hit $400 at $399.86. Last month, we were paid by TRP, our biggest energy holding. This month, it's Enbridge's turn. They provide us with $141.04 in dividends and represent 6% of our annual dividend income. Despite the market entering bear territory in the US again and the TSX down 13% year to date, ENB is up 3% on the year, not including its dividends. With its limited increase in FCF, I don't know if it'll do more than a 3% dividend increase next. After this big dividend payment, we are at $540.90. Our next pay was $141.26 from Fiera Capital Corp. They provide us also with 6% of our yearly dividend income. FSZ is currently trading far above its average yield of 7% over the past 5 years. Last year, there was a tiny 2.4% dividend raise. This is a high-risk holding, with its payout ratio now at 170%, with its drop in revenue. I wanted to accumulate more during the 2020 crash, but now I'm happy I held off as I'm losing confidence FSZ will be able to continue to grow its revenue in these turbulent market conditions. I'm monitoring them very carefully as they are now on the chopping block. After 9 paychecks, we reached $682.16. Our largest holding, Riocan Real Estate Investment Trust, paid us a distribution of $64.93 across all of our Tfsa accounts. Remember, this doesn't include our RRSP or taxable accounts, just our Tfsa accounts. Riocan provides us with 8.4% of our forward yearly dividend income. It has a 5-year average dividend yield of 6.2%, which is higher than the current yield of 5.6% after the market fell off of a cliff. If Riocan hadn't slashed its dividend last year, this would be yielding 7.7% right now. I don't expect the distribution to come back very fast with the increased cost of borrowing that just keeps on rising. I'll keep dripping this all I can at this great valuation, 25% below its NAV of $25. This brings us to $749.09. Lastly, we received $66.58 from First National Financial. FN provides us with 8.4% of our annual dividend income without their special dividend. This stock has tanked since mid-2021 and hasn't recovered. It currently provides a 6.5% yield. With a 5-year average of 5.6%, this is technically undervalued. They haven't risen their dividends yet, and it has been a year and 4 months now. I'm not too worried if they pause the dividend raises during a turbulent time to shore up the business. A dividend increase pause is much better than a dividend cut of any sort. After all 11 paychecks this month, our grand total is $813.67. Our 3 largest dividend payments accounted for $393.57, or 48% of our dividend income for the month of September. As we grow the portfolio, this should moderate down to about 35% for the month. We never want to be too dependent on any one stock to help our portfolio grow in the event of a dividend cut or divestment. As you can see from the breakdown, no one industry or stock dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. And we had 2 more dividend increases this month. This makes a nice little streak for us of 2 months after that dry spell. First, Pembina Pipeline had a 3.6% dividend increase to 21.75 cents a share. This increase breaks their 3-year duck. With the raise, we added $16.38 to our yearly dividend income. Next, Fortis Inc. had a 5.6% dividend increase, or 3 cents, to 56.5 cents a share. This increases their dividend streak to 49 years, 1 away from Dividend King territory. With this raise, we added $11.60 to our forward annual dividend income. Those raises are the equivalent of adding $700 of cold, hard cash at a 4% yield. That's the beauty of dividend growth. So far this year, we have received $6,642.11 in dividends with a yield on cost of 6.62%. Our forward annual dividend income is $9,391 and growing fast. We expect our dividend income to continue to snowball as we drip and stay completely invested, putting those dividends to work for us. My dividends are my little minions that work hard for me when I can't. With our minions working hard for us, we can forecast where we'll be in about 10 years. I hope to outpace this forecast as the Tfsa contribution room continues to grow in the future, especially with this high inflation. Thank you so much for supporting the channel by smashing that like and subscribe button. Thank you so much for watching this update. Until next time, I'm Mr. Financial.